The U.S. just lost tens of thousands of jobs in February, not gained, lost. The Washington Post called it a warning sign for the economy, but that's not the real story. The real story is what just happened underneath those numbers. The Sahm Rule triggered, and the Sahm Rule has never been wrong. It's called every recession since the 70s with zero false positives. Zero. And it just flashed red for the first time since the pandemic. This isn't some obscure academic theory. This is the indicator that called the financial crisis months before anyone official admitted we were in recession. It spotted the dot-com crash when everyone was still talking about the new economy, and right now it's screaming at us again. What's up, guys? It's Tom here. If you've been following this channel, you know we've been ahead of the curve on pretty much everything lately. Called the jobs overcount months before the BLS finally admitted they were off by hundreds of thousands of jobs. I mean, we were literally showing you the data discrepancies in real time while everyone else was celebrating fake job growth, flagged Bitcoin's crash before it dropped a third from its highs. Remember that maximum risk score I showed you in December?
Yeah.
That aged well. The safe portfolio strategy we've been running has been quietly outperforming while everyone else got chopped up in this volatility, and the recession model I track every single day, all the indicators updated in real time, just jumped to 67 out of 100. That's official pre-recession territory. It was much lower just a week ago. That kind of move in 7 days is massive for this model, but today we need to talk about why it moves so fast, because the Sahm Rule isn't just another indicator, it's the most accurate recession predictor in modern history, and it just told us something nobody wants to hear. So let me break down what the Sahm Rule actually is, because most people have never heard of it despite its perfect track record. Created by economist Claudia Sahm when she was at the Fed, it's deceptively simple. You take the current 3-month moving average of the unemployment rate and compare it to the lowest 3-month average from the past year. When that difference hits half a percentage point, the rule triggers. That's it. No complex formulas, no weighted averages of dozens of different variables, no machine learning algorithms, just unemployment rising fast enough to cross a single threshold. And here's what makes it absolutely terrifying. If you have money in the market, it's never missed every recession for decades, called it every market crash, got it every time the economy rolled over. Perfect timing, and it's never cried wolf. Zero false alarms. 0 times it said recession when there wasn't one. That's a better track record than literally any economist, any investment bank, any government agency. Better than the yield curve, better than GDP forecasts, better than everything. Now, here's why this thing works so well, and why it's not going to suddenly stop working now. During normal economic times, companies don't fire people. Think about it from a business owner's perspective. Hiring is expensive. You've got to post jobs, screen resumes, do interviews, run background checks. Training is expensive. Takes months to get someone productive, and good employees are hard to find. So when things slow down a little, maybe sales drop slightly one quarter, you don't panic and start laying people off. You tighten other expenses first. Cancel the office renovation, skip the company retreat, delay the new software purchase. You keep your workforce because you assume things will get better next quarter. That's why during normal slowdowns, unemployment stays flat or maybe ticks down slightly, but when recession actually hits, everything changes at once. Revenue doesn't just dip, it falls off a cliff. Credit tightens because banks get scared. Customers delay purchases, supply chains get disrupted, and suddenly what looked like a temporary slowdown becomes an existential threat. The first thing companies cut is payroll because it's usually the biggest expense and the fastest to eliminate. You can't instantly cut your rent or cancel long-term contracts, but you can lay off people today and save their salaries starting tomorrow. So unemployment doesn't creep higher gradually during real recessions. It jumps hard and fast. And that jump, that rapid acceleration, that's what the threshold catches. It's the exact moment when the labor market breaks, the moment businesses stop believing things will get better next quarter and start making survival decisions. So where are we right now? The 3-month average unemployment rate just crossed the line. The Sahm Rule triggered. We're officially in the danger zone, and it's not just that one number. When I look at the full labor market data the model tracks, I'm seeing breakdown across multiple indicators. Job creation has basically stalled out. We're adding barely enough jobs to keep up with population growth. The latest report showed weak job gains, and the trend is clearly deteriorating. For context, you need substantial job growth per month just to keep up with people entering the workforce. So we're actually falling behind. That's stall speed for the economy. Initial jobless claims are trending higher, not skyrocketing yet, but the trend is clear. Continuing claims. That's people who stay on unemployment longer because they can't find new jobs. Those are starting to rise too. And remember, this is the same Bureau of Labor Statistics that just admitted months ago they overcounted jobs by massive amounts last year. Their preliminary numbers have been consistently overstating job growth, so the real situation might actually be worse than these official figures. The model accounts for that historical bias, which is part of why it moved to 67 so quickly. Let me put this in historical perspective, because the timing matters more than most people realize. During the financial crisis, the Sahm Rule triggered months before the National Bureau of Economic Research. The official recession dating committee admitted we were in recession, but by the time they made it official, the market had already crashed. Bear Stearns was gone, Lehman Brothers collapsed, the financial system nearly melted down. The damage was already done. During the dot-com crash, the rule triggered months before the official call. The NBER didn't date that recession until much later. But the Nasdaq had already crashed massively from its peak. Hundreds of companies had gone bankrupt. The bubble had already burst. During the pandemic, the rule triggered when unemployment skyrocketed because of lockdowns. But even before that massive spike, the market had already crashed when everyone realized the virus was going to shut down the global economy. You see the pattern here. The rule doesn't predict recessions. It identifies when they've already started. That's the key insight everyone misses. By the time the Sahm Rule triggers, you're not looking at future risk, you're looking at present reality that most people haven't recognized yet. The recession has begun. The question is how deep it goes and how long it lasts. And here's where it gets really ugly, because unemployment creates a vicious feedback loop that feeds on itself. People lose jobs, so they cut spending immediately. They cancel vacations, delay car purchases, eat out less, shop at discount stores. Businesses see lower revenue from reduced consumer demand, so they lay off more people to cut costs, which means even more people lose jobs and cut spending further. Meanwhile, credit gets tighter because banks start worrying about loan defaults from unemployed borrowers, so businesses can't get financing to survive the downturn or invest in growth. Investment spending drops because nobody knows where demand is going or when it might recover. Commercial real estate suffers because empty storefronts and office buildings don't pay rent. Local governments see tax revenue fall, so they cut services and lay off workers too. It's self-reinforcing, and it accelerates once it gets started. And we're starting to see early signs of this cycle beginning right now. Consumer sentiment dropped sharply in the latest survey. People are worried about their jobs and they're pulling back spending preemptively. The model's consumer indicators are flashing warning signs across multiple categories. Retail sales growth is slowing, credit card delinquencies are ticking up, auto sales are soft, even worse, oil prices are creeping higher again, which feeds directly into inflation and squeezes household budgets even more. Expensive gas acts like a tax increase on every working family. So given all this, there are really three ways this situation plays out over the next 6 to 12 months. Scenario 1 is the mythical soft landing that everyone hopes for. The Fed cuts interest rates just enough to stabilize employment without triggering more inflation. Maybe unemployment peaks at moderate levels and starts coming back down by summer. The Sahm Rule was technically right. We had a shallow recession, but it was brief and mild. Markets recovered by year-end because the damage stayed limited. Corporate earnings only dropped modestly instead of the usual massive decline. This is the best case, but it requires perfect timing from the Fed and no external shocks. Scenario 2 is the standard recession playbook we've seen before. Unemployment rises significantly over the next 6 to 9 months. The market drops substantially from current levels. Corporate earnings fall as demand collapses. The Fed cuts rates aggressively, but it takes over a year for lower rates to actually work through the system and restart growth. This is basically what happened during the dot-com crash. Painful but manageable if you're positioned right. Scenario 3 is the nightmare that keeps me up at night. The labor market collapse accelerates faster than the Fed can respond. We get very high unemployment, but inflation stays elevated because of oil prices, supply chain disruptions, and government spending. So the Fed can't cut rates aggressively because they're afraid of making inflation worse. We get stagflation, high unemployment, and high inflation at the same time. That's the 70s playbook, and it's absolutely brutal for both stocks and bonds right now. Based on all the data, the model tracks, Scenario 2 looks most likely. But Scenario 3 has meaningful probability, which is way higher than it should be in a healthy economy. But here's what really doesn't make sense to me right now. The VIX, the market's fear gauge, has been spiking hard over the past week, hitting levels we haven't seen since the banking crisis last spring. That tells you professional traders are buying insurance against a crash. They're scared, but at the same time, the S&P 500 is still within striking distance of all-time highs. Bond yields are barely moving despite all this labor market weakness. It's like the market knows something's fundamentally wrong, but can't decide what to do about it. You've got this bizarre disconnect where the smart money is hedging for disaster, but the index funds keep buying because that's what they do every month. And that's exactly the kind of environment where you get really violent moves when the reality finally hits. Everyone's positioned for gradual change. Nobody's ready for the Sahm Rule to be right again. When the selling starts, it's going to be brutal because there's no liquidity underneath these prices. The Fed's quantitative tightening sucked billions out of the system. Corporate buybacks are slowing because earnings are under pressure. Foreign buying has dried up because their economies are struggling too. So when sentiment finally shifts, there won't be enough buyers to cushion the fall. So what does this actually mean for your money and your financial future? If you're sitting in index funds thinking you're diversified, you're essentially making a bet that this time is different, that the Sahm Rule's perfect multi-decade track record ends here. Maybe it does. Maybe we've fundamentally changed how the economy works. But the odds are not in your favor, and the downside, if you're wrong, is huge. If you're carrying debt, credit cards, variable rate loans, home equity lines, you're about to get squeezed from both sides. Rising unemployment means your job is less secure right when you need steady income most. And if the Fed can't cut rates fast enough because of inflation concerns, your borrowing costs stay high or even go higher. That's a recipe for financial disaster for overleveraged households. If you're thinking about buying a house, you're looking at a market where mortgage payments already eat up nearly half of median household income in most major cities. Add rising unemployment, reducing the buyer pool, and potentially higher mortgage rates if inflation stays sticky, and affordability gets even worse. Housing prices might finally start falling, but only because nobody can qualify for loans anymore. If you're close to retirement, this is probably your biggest test since the financial crisis. Your timeline is short, so you can't just ride out a multi-year bear market. And if we get stagflation, both your stocks and bonds get crushed simultaneously. That traditional portfolio mix, it failed miserably in the 70s when we had this same combination of problems. Look, I've been running a defensive strategy since I launched this model back in November, and nothing about the Sahm Rule triggering makes me want to get more aggressive. Heavy cash position earning solid returns in money markets, significantly reduced equity exposure focused on defensive sectors, international diversification to hedge dollar risk. It's outperformed the broader market with way less volatility and drawdown risk. I'm not changing that positioning. Now, if anything, the Sahm Rule trigger reinforces exactly why this approach makes sense. This isn't about trying to time the exact bottom of the market. That's impossible and unnecessary. It's about not getting crushed on the way down, so you still have capital to deploy when opportunities actually present themselves. The model shows that historically, during Sahm Rule recessions, utilities and consumer staples dramatically outperform. Utilities stay positive while the broader market drops substantially. That's a massive spread just from being in the right sectors. Consumer staples like Walmart and Procter & Gamble actually benefit when people trade down and focus on necessities instead of discretionary purchases. The math works if you're willing to be patient and ignore the noise. And I get it. Nobody wants to hear this stuff, especially right now when everything feels uncertain already. If you're worried about your job, or your savings have been getting crushed by inflation, or you're trying to plan for your kids' college or your own retirement, charts and models don't pay the bills. This isn't some academic exercise. These are real decisions that affect real families. But here's the thing, knowing what's actually happening, having access to the real data instead of just the sanitized headlines, that's better than being blindsided when reality finally hits. At least you can make informed decisions about your own situation. Bottom line, the Sahm Rule just triggered. It's never been wrong in decades of economic data. The recession model I track daily now reads 67 out of 100, firmly in pre-recession territory. The labor market is falling apart despite what the headlines try to tell you, and anyone with money at risk should be getting defensive right now, not hoping for the best. If you want to track this stuff in real time instead of waiting for quarterly reports and backward-looking government data, I built a complete dashboard at recessionistpro.com. All the indicators updated daily, forward forecasts, sector rotation signals, everything for $20 a month. Here's exactly what to watch in the coming weeks. If unemployment keeps accelerating at the current pace, we're looking at scenario 3 territory, the accelerating breakdown case. And if continuing claims, that's people staying on unemployment longer because they can't find new jobs, break meaningfully higher in the next month. That confirms the feedback loop is starting and this recession will be deeper than average. Those are the tripwires that separate a mild downturn from something much worse.